If you are over 65 years old, you cannot afford to make mistakes with your money. You do not have time to recover from a market crash. You do not have decades for your investments to compound. You cannot go back to work if your portfolio gets cut in half. This is it. The money you have right now needs to last for the rest of your life. And if you are managing it the way most financial advisors tell you to, you are taking far too much risk. You are exposed to dangers that could devastate your retirement. And I am going to tell you exactly how to fix that. I am going to show you how to build what I call a fortress portfolio. A portfolio designed not to make you rich, but to keep you safe, to generate the income you need, to preserve your capital, and to let you sleep at night knowing that no matter what happens in the markets, you are going to be okay. Let me start by telling you why most retirement advice is wrong. You have probably heard the rule that you should subtract your age from 110 or 120 to determine how much you should have in stocks. So if you are 65, you should have 45 to 55% in stocks and the rest in bonds. This rule is garbage. It is outdated. It does not account for how long people are living now. It does not account for inflation. And it does not account for the fact that bonds have been a terrible investment for the past few years and might continue to be terrible. Following this rule mechanically without thinking about your specific situation is a recipe for either running out of money or taking too much risk. Here is what most financial advisors do not tell you. When you are over 65, you are not one person with one goal. You are actually managing for two different time horizons simultaneously. You have short-term needs, money you need in the next 5 to 10 years for living expenses. That money cannot be at risk. It needs to be safe and accessible. Then you have long-term money, money you probably will not need for 15 or 20 years. That money can take some risk because it has time to recover from market downturns. Most advisors put all your money in the same 6040 or 5050 portfolio and call it a day. That is lazy. That is not customized to your needs. And that is not how I would manage money if I were in your position. Let me tell you a story that shaped how I think about retirement portfolios. In 2008, during the financial crisis, I watched what happened to retirees. The stock market fell 50%. People who had $1 million in their retirement accounts suddenly had $500,000, and many of them panicked. They sold at the bottom because they were terrified of losing more. They locked in their losses, then they missed the recovery. Their $1 million portfolio became a $500,000 portfolio permanently because they sold at the worst possible time. But here is what made it even worse. These were people in their 60s and 70s. They did not have time to make that money back. They did not have earned income to contribute more savings. They were stuck living on half of what they planned to have. Some had to go back to work. Some had to move in with their kids. Some had to drastically reduce their standard of living. It was devastating, and it was preventable. The ones who survived 2008 with their wealth intact were the ones who had structured their portfolios correctly from the beginning. They had enough cash and safe investments to cover 5 years of living expenses. So when the market crashed, they did not need to sell stocks. They lived off their cash and bonds while the stock market was down. They waited, and when the market recovered over the next few years, their stock positions came back. They did not panic because they did not need the money immediately. That is the key insight. You can only hold stocks through a bear market if you do not need to sell them. And you only do not need to sell them if you have other money available to live on. So let me walk you through exactly how I would build a fortress portfolio if I were 65 years old today. I am going to break this into different buckets. Each bucket has a specific purpose. Each bucket has specific investments. And together they create a portfolio that can withstand anything the markets throw at you. The first bucket is what I call the emergency and immediate needs bucket. This is cash and cash equivalents, money market funds, treasury bills, high-yield savings accounts. This bucket needs to hold at least 2 years of living expenses, maybe 3 years if you want to be extra conservative. Let us say you need $60,000 per year to live on after accounting for Social Security and any pension income. That means this bucket needs to have $120,000 to $180,000 in it. I know that sounds like a lot of cash to hold. I know you are worried about inflation eroding the value, but this is your insurance policy. This is what lets you sleep at night when the stock market crashes 30%. You have 2 or 3 years of expenses and safe money that is not going down. You do not have to sell stocks in a panic. You can wait for recovery. Right now, with money market funds and treasury bills paying over 5%, this cash is actually earning a decent return. That is the silver lining of higher interest rates. Your cash is not dead money anymore. It is earning 5%. That is not enough to beat inflation over the long term, but it is respectable. And the primary purpose of this bucket is not growth, it is safety and liquidity. You can access this money instantly if you need it. No market risk, no interest rate risk, just cash sitting there ready to be used. Some people will say this is too conservative. They will say you are leaving money on the table by holding so much cash. But I have seen what happens to people who do not have enough cash when markets crash. They are forced to sell at the bottom. They destroy their wealth. I would much rather hold a little too much cash than not enough. The second bucket is what I call the income and stability bucket. This is short to intermediate term bonds, high quality corporate bonds, treasury notes, municipal bonds if you are in a high tax bracket. The purpose of this bucket is to generate income and provide stability. You want this bucket to hold another 3 to 5 years of living expenses. So if you need $60,000 per year, this bucket should have $180,000 to $300,000. These bonds should have maturities of 1 to 5 years. You do not want long duration bonds because they are too volatile when interest rates change. You want short duration bonds that are going to mature relatively quickly and can be reinvested at current rates. Let me explain why bonds are important, even though they have had a rough few years. Bonds provide ballast. When stocks go down, bonds usually go up or at least stay stable. In 2008, stocks fell 50%, but high-quality bonds were flat or slightly positive. That stability is crucial when you are retired. You need some part of your portfolio that is not wildly volatile. Now, I am not going to lie to you. If interest rates rise significantly from here, bonds will lose value in the short term. But if you hold individual bonds to maturity, you get your principal back. You do not have permanent losses. And the income from bonds is predictable and reliable. You know exactly how much you are going to receive and when. I prefer individual bonds over bond funds for retirees. Here is why. When you own an individual bond, you know the exact maturity date and the exact amount you will receive. If you buy a $10,000 treasury note maturing in 3 years, paying 4%, you know you will get $400 per year for 3 years and then your $10,000 back. It is predictable. It is safe. With a bond fund, you do not have that certainty. The fund owns hundreds or thousands of bonds with different maturities. The net asset value fluctuates daily based on interest rates. You might need to sell at a loss if you need money at the wrong time. For retirees, the certainty of individual bonds is worth the extra work of building a bond ladder. A bond ladder is simple. You buy bonds that mature in each of the next several years. One bond maturing in 1 year, one maturing in 2 years, one in 3 years, one in 4 years, one in 5 years. As each bond matures, you reinvest the proceeds at current interest rates into a new 5-year bond. This keeps your ladder constant and gives you flexibility. If interest rates are rising, you are continually reinvesting at higher rates. If you need cash, you just let a bond mature and do not reinvest it. It is elegant and simple and perfect for retirees. The third bucket is what I call the dividend growth bucket. This is high-quality dividend-paying stocks, companies with long track records of paying and growing dividends, companies with strong balance sheets, and recession-resistant businesses. This bucket might hold 20 to 30% of your portfolio, depending on your risk tolerance and how much money you have. The purpose is to generate income that grows over time and provides some inflation protection. Let me be very clear. This is not where you swing for the fences. This is not where you buy speculative growth stocks or volatile technology names. This is where you buy boring, stable dividend aristocrats, companies that have increased their dividends every year for 25 or 50 years. Here are the types of companies I am talking about. Johnson & Johnson, a healthcare conglomerate that has increased its dividend for over 60 consecutive years through recessions, through market crashes, through every crisis. They kept raising the dividend. Procter & Gamble, consumer staples. People buy toothpaste and toilet paper and diapers no matter what the economy is doing. Dividend increased for over 60 years. Coca-Cola, people drink Coke in good times and bad times. Dividend increased for over 60 years. 3M, industrial products. Dividend increased for over 60 years. These are the types of companies you want in this bucket. Companies where the dividend is safe, where the business is resilient, where you can hold through a market crash and keep collecting your dividends. The current dividend yield on these stocks is typically 2 to 4%. That might not sound like much, but remember that the dividend grows every year. If you buy a stock yielding 3% today and the dividend grows 5% per year, in 10 years you will be yielding 4.9% on your original investment. In 20 years, you will be yielding 7.9%. The income compounds, and that is your inflation protection. As the cost of living goes up, your dividend income goes up too. This is much better than a bond where the interest payment is fixed forever. The dividend growth bucket provides income today and increasing income tomorrow. Now, the stock prices of these companies will fluctuate. In a bear market, they might decline 20 or 30%, but remember, you do not need to sell them. You have your cash bucket and your bond bucket to live on. You can just hold these stocks and keep collecting the dividends. In fact, when the market crashes and these high-quality stocks go on sale, you can use maturing bonds to buy more. This is how you build wealth, even in retirement. You buy quality assets when they are cheap and hold them forever. One of my mentors taught me that time in the market beats timing the market. This is especially true with high-quality dividend stocks. Just own them. Reinvest the dividends when you do not need the income. Let them compound, and over 20 or 30 years, they will grow into a significant portion of your wealth. The fourth bucket is what I call the inflation protection and growth bucket. This is where you can take a bit more risk if you have the capacity and temperament for it. This bucket might hold 10 to 20% of your portfolio. Maybe less if you are very conservative. Maybe a bit more if you have more than enough money to cover your needs and want to leave a larger legacy. This bucket includes some growth stocks, some international exposure, some real assets. The purpose is to keep up with or beat inflation over the long term and provide some growth for your heirs. Let me be specific about what goes in here. A small allocation to growth stocks, maybe an S&P 500 index fund for broad market exposure, maybe a NASDAQ 100 fund for technology exposure, maybe some healthcare stocks since healthcare spending increases as the population ages, international stocks for diversification, emerging markets if you want more growth potential, real estate investment trusts for exposure to property values and rental income, maybe some commodities or inflation-protected securities if you are worried about inflation, maybe even a small allocation to gold as disaster insurance, 5 or 10%, not as an investment but as a hedge against catastrophic scenarios. The key with this bucket is that you should only include it if you can afford to see it decline 40 or 50% without panicking. If your entire net worth is $500,000 and you need every penny to live on, you probably should not have much in this bucket, maybe 5% at most. But if you have $2 million and your expenses are $80,000 per year, you have plenty of cushion. You can afford to take some risk with a portion of your portfolio because even if it goes to zero, which it would not, you still have more than enough to live on. Your risk capacity is higher. So you can allocate more to growth. Now let me talk about what you absolutely should not have in your portfolio if you are over 65. First, no speculative investments, no meme stocks, no cryptocurrencies, no penny stocks, no options, unless you truly understand them and are using them for income strategies like covered calls on stocks you already own. No investments you do not understand. No products pitched to you by salespeople promising guaranteed high returns. If it sounds too good to be true, it is. At this stage of life, you cannot afford to gamble. Every dollar you lose is a dollar you cannot replace. Preservation of capital is more important than growth. Second, no illiquid investments. No real estate that you cannot easily sell. No private equity funds with 10-year lockups. No annuities with massive surrender charges if you need to get out. You need flexibility. You need to be able to access your money if circumstances change. Health issues arise. Long-term care needs emerge. Family emergencies happen. If your money is locked up in illiquid investments, you are stuck. You might be forced to take loans or sell other assets at bad times. Keep your portfolio liquid. Third, no excessive concentration. Do not have 30% of your portfolio in your former employer's stock just because you worked there for 40 years and you love the company. That is too much risk in one stock. Diversify, spread your risk across many companies and asset classes. I have seen too many people retire with huge positions in one stock and then watch that stock collapse. Enron employees, Lehman Brothers employees, General Electric retirees who saw their stock fall 80%. It is heartbreaking and preventable. Diversify. Fourth, no high-fee products. No mutual funds charging 1 or 2% per year in expense ratios when you can get equivalent index funds for 0.1%. No financial advisors charging 1% of assets under management to put you in expensive mutual funds that underperform. Fees are a cancer on your portfolio. Over 20 or 30 years, high fees can reduce your wealth by hundreds of thousands of dollars. Be ruthless about minimizing costs. Use low-cost index funds. Use discount brokers. Manage it yourself if you can. Or hire a fee-only fiduciary advisor who charges a flat fee for a financial plan, not a percentage of assets. Let me walk through an example portfolio to make this concrete. Let us say you are 65 years old, You have $1 million in retirement savings. You receive $30,000 per year from Social Security. You need $70,000 per year total to live comfortably. So you need $40,000 per year from your portfolio. Here is how I would structure it. $120,000, that is 3 years of the $40,000 you need from the portfolio. Put this in a money market fund or treasury bills, earning 5%. Income bucket, $240,000. That is 6 years of income needs. Build a bond ladder with individual investment grade bonds maturing over the next 6 years. Aim for an average yield of 4 to 5%. Dividend bucket, $400,000. High quality dividend stocks yielding 3% on average. That generates $12,000 per year in dividend income. Growth bucket, $240,000. S&P 500 index fund, some international stocks, maybe a REIT fund. Let us see how this works. Your cash bucket generates about $6,000 per year in interest. Your bond bucket generates about $10,000 per year in interest. Your dividend bucket generates $12,000 per year in dividends. That is $28,000 per year in income. You need $40,000. So you need to draw down $12,000 per year from your portfolio. You can take that from maturing bonds or from the cash bucket. Meanwhile, your growth bucket is not being touched. It is compounding. And your dividend bucket is growing as those companies increase their dividends. Now, let us stress test this portfolio. What if the stock market crashes 40% in year 2 of your retirement? Your growth bucket falls from $240,000 to $144,000. Your dividend bucket falls from $400,000 to $240,000. Your portfolio is now worth about $750,000 instead of $1 million. That is a $250,000 loss. It is painful. But are you okay? Yes, because you still have $120,000 in cash and $240,000 in bonds. That is $360,000 of safe money, enough to cover 9 years of your $40,000 annual need. You do not have to sell any stocks at depressed prices. You live off your cash and bonds. You wait for the market to recover. And based on history, the market will recover. It always has. Maybe it takes 3 years. Maybe it takes 5 years. But you have 9 years of safe money. You are fine. Meanwhile, your dividend stocks keep paying dividends even though their prices are down. If anything, the dividend yield is now higher because the prices are lower. You are collecting 3% on your original $400,000, which is $12,000 per year. But the stocks are now worth $240,000 and still paying $12,000. So the yield is now 5%, and you can reinvest those dividends to buy more shares at lower prices. When the market recovers, you will have more shares and your wealth will recover faster than if you had sold. This is the power of a fortress portfolio. It is designed to survive worst-case scenarios. It gives you flexibility. It gives you time. It lets you avoid forced selling at the worst possible time. And it allows you to stay invested so you participate in the recovery. Compare this to someone who had $600,000 in stocks and $400,000 in bonds. When the market crashes, their stocks fall to $360,000. They need $40,000 per year to live. Their bonds are generating maybe $16,000 per year. They are short $24,000. They have to sell stocks. They sell $24,000 of stocks at a 40% loss. The next year, same thing. They keep selling stocks at depressed prices. By the time the market recovers, they have sold so many shares that they do not participate fully in the recovery. Their portfolio never gets back to 1 million. They have permanently impaired their wealth. That is what happens when you are not properly structured. Let me address a concern some of you might have. What if I live a really long time? What if my money runs out? This is a valid fear. People are living longer than ever. If you retire at 65, you might live to 90 or 95 or even 100. That is 30 or 35 years that your money needs to last. Here is how the Fortress portfolio addresses this. First, you are not spending down all your capital. You are generating income from interest and dividends, and you are allowing your growth bucket to compound. Over time, your portfolio can actually grow even while you are taking withdrawals. Let me show you the math. You start with 1 million, you withdraw 40,000 per year, but your portfolio is generating 28,000 in income. So your net withdrawal is only 12,000 per year. That is a 1.2% withdrawal rate on your starting capital. And your growth bucket, which started at 240,000, is compounding at hopefully 7 to 8% per year over the long term. Even if it falls in half in a bear market, it recovers and keeps growing. The 4% rule says you can safely withdraw 4% of your starting portfolio balance per year adjusted for inflation and have a high probability of not running out of money over 30 years. You are only withdrawing 1.2% net after income. You are being far more conservative than the 4% rule. Your odds of running out of money are extremely low. In fact, you will probably die with more money than you started with, and that is fine. That is a good problem to have. You can leave it to your kids or grandkids or charity. The goal is not to spend your last dollar on your last day. The goal is to never worry about running out of money. Now, let me talk about taxes, because this is crucial for retirees. You need to be smart about where you hold different investments and which accounts you withdraw from first. If you have money in tax-deferred accounts like traditional IRAs or 401ks, you will pay ordinary income tax on withdrawals. If you have money in Roth IRAs, withdrawals are tax-free. If you have money in taxable brokerage accounts, you pay capital gains tax on gains and get taxed on dividends and interest. The strategy is to minimize your lifetime tax burden. Generally, you want to withdraw from taxable accounts first. Let your tax-deferred accounts keep growing. The longer they compound tax-deferred, the better. Then start drawing from tax-deferred accounts when you have to. You are required to take minimum distributions from traditional IRAs starting at age 73. So at that point, you have no choice. But before then, be strategic. Roth IRAs are the most valuable accounts. They grow tax-free and withdraw tax-free. Let them compound as long as possible. In fact, you do not have required minimum distributions from Roth IRAs during your lifetime. You can let them grow forever and pass them to your heirs. They are the ultimate tax-efficient vehicle. If you have the opportunity to convert traditional IRA money to Roth, consider it. You will pay tax on the conversion, but then that money grows tax-free forever. This is especially good to do in years when your income is lower, maybe in early retirement before you start Social Security or before required minimum distributions kick in. You might be in a lower tax bracket. Convert some traditional IRA money to Roth. Pay the tax at a lower rate. And now that money is tax-free forever. Another strategy is tax loss harvesting in your taxable accounts. If you have investments that are down, you can sell them and realize the loss. That loss can offset other capital gains, or up to $3,000 of ordinary income per year. Then you can immediately buy something similar, so you stay invested. For example, if you own an S&P 500 fund that is down, you sell it for the loss. Then you immediately buy a total market fund or a different S&P 500 fund. You captured the tax loss, but you stayed invested in stocks. This reduces your tax bill over time. These strategies can save you tens of thousands of dollars in taxes over a 20 or 30-year retirement. Let me talk about Social Security timing, because this is one of the most important decisions you will make. You can start taking Social Security as early as age 62, but your benefit is reduced by about 30% compared to waiting until full retirement age, which is 66 or 67, depending on when you were born. If you wait until age 70, your benefit increases by about 24% compared to full retirement age. So there is a huge difference between starting at 62 versus waiting until 70. If your full retirement age benefit is $2,500 per month, taking it at 62 gives you $1,750 per month. Waiting until 70 gives you $3,100 per month. That is a 77% difference, and that is for the rest of your life. Plus, Social Security has cost of living adjustments. It is inflation protected. This is incredibly valuable. So when should you take it? It depends on your health and your financial situation. If you are in poor health and do not expect to live a long time, taking it early makes sense. Get the money while you can. But if you are healthy and expect to live into your 80s or 90s, waiting is usually better. The break-even age is typically around 80. If you live past 80, you are better off having waited. And most people in reasonable health at 65 will live past 80, women especially. So for most people, delaying Social Security is the right move. But how do you pay for living expenses while you wait? You use your portfolio. You draw down your portfolio from age 65 to 70 to cover expenses. Then at 70, you start Social Security at the maximum amount. Now, your Social Security covers most of your living expenses, and you need much less from your portfolio. This makes your money last longer. There is also a strategy for married couples. The higher earning spouse should delay until 70 to maximize their benefit. When that spouse dies, the surviving spouse gets the higher of the two benefits. So if the husband was getting $3,000 per month and the wife was getting $2,000 per month, when the husband dies, the wife steps up to $3,000 per month. By having the higher earner delay until 70, you are maximizing the survivor benefit. This is especially important because the surviving spouse often has only one Social Security check but still has most of the same living expenses. That bigger check makes a huge difference. The lower earning spouse can take their benefit earlier if needed for cash flow, but the higher earner should delay until 70 if at all possible. This is one of the best financial decisions you can make. Let me address long-term care because this is a huge risk for retirees. The average cost of a nursing home is over $100,000 per year. Assisted living is $50,000 to $60,000 per year. If you or your spouse need care for several years, it can easily cost $300,000 or $400,000 or $500,000. That can wipe out your savings. So how do you plan for this risk? You have a few options. One is to self-insure. Basically, you say, I have enough money that I can afford to pay for long-term care if I need it. If you have $2 or $3 million, this might make sense. You have the resources to cover it. But if you have $500,000 or $1 million, paying $100,000 per year for nursing care is devastating. You cannot afford to self-insure. Option 2 is long-term care insurance. You buy a policy that pays for care if you need it. The problem is these policies are expensive, and the premiums keep going up. Insurance companies have lost a lot of money on long-term care policies because people are living longer and needing care for longer than the insurance companies anticipated, so premiums have skyrocketed. If you are 65 and buy a policy now, you might pay $5,000 or $6,000 per year, and that premium could double over the next 10 years. It is hard to justify that cost. Many people pay premiums for decades and never use the policy. It feels like wasted money. Option 3 is a hybrid policy. This combines life insurance with long-term care coverage. You pay a lump sum, maybe $100,000, into a policy. If you need long-term care, the policy pays out $300,000 in benefits. If you never need long-term care, when you die, your heirs get a death benefit. So the money is not wasted. You either use it for care or your heirs get it. These policies are more attractive than traditional long-term care insurance because you are guaranteed to get something. The downside is the upfront cost. You need to have $100,000 sitting around that you can put into the policy. Option 4 is Medicaid planning. Medicaid will pay for long-term care if you are poor enough. The problem is you have to spend down almost all your assets to qualify. You can keep your house and a small amount of cash, but everything else has to be spent on care before Medicaid kicks in. Some people do aggressive Medicaid planning where they give away their assets to their kids or put them in trusts so they qualify for Medicaid. But this is risky. If you give away your assets and then need care within 5 years, Medicaid will not cover you. You created a 5-year look-back period, and you no longer have the assets because you gave them away. So you are stuck. Medicaid planning is a last resort, and you need an expert elder law attorney to do it right. It is not something you do casually. My recommendation for most people is to plan for long-term care costs in your budget. Assume you might need $100,000 to $200,000 for care at some point. Make sure your portfolio can cover it. If you can afford a hybrid policy, that is a good option for peace of mind. But do not bankrupt yourself paying long-term care insurance premiums. And definitely do not give away your assets to your kids to qualify for Medicaid unless you are truly out of options. You worked your whole life for this money. You should be able to use it if you need care. That is what it is there for. Let me talk about working with financial advisors because many of you probably have one or are thinking about hiring one. There are good advisors and there are bad advisors. A good advisor helps you create a comprehensive financial plan. They look at your income sources, your expenses, your tax situation, your estate plan, your insurance needs. They create a customized strategy for your specific situation. They recommend low-cost diversified investments. They charge a transparent fee, either a flat fee for the financial plan or an hourly rate or a small percentage of assets if they are managing investments. They are fiduciaries, which means they are legally required to act in your best interest. A bad advisor is a salesperson in disguise. They sell you expensive annuities or life insurance policies or actively manage mutual funds because they get big commissions. They make investment decisions based on what generates the most fees for them, not what is best for you. They are not fiduciaries. They only have to meet a suitability standard, which is much lower. As long as the product is suitable for someone like you, they can sell it even if there are better options. These advisors can cost you hundreds of thousands of dollars over your retirement in excessive fees and underperformance. How do you know if your advisor is good or bad? Ask these questions. Are you a fiduciary? If they say no or they hedge, run away. What are your fees? They should be able to give you a clear answer in dollars or percentage. If it is complicated or opaque, that is a red flag. How are you compensated? If they say commissions or they get paid by the products they sell, run away. What investments do you recommend? If they push annuities or loaded mutual funds or proprietary products, run away. You want an advisor who recommends low-cost index funds and transparent strategies. Do you have any conflicts of interest? They should disclose if they get any payments from investment companies or insurance companies. If they do, that is a conflict of interest. Honestly, Most people can manage their own retirement portfolio if they educate themselves and follow a simple strategy like what I have outlined. You do not need to pay someone 1% of your assets every year to put you into a standard mix of index funds. That is $10,000 per year on a $1 million portfolio. Over 20 years, at 1% per year, you will pay over $200,000 in fees, assuming your portfolio grows. That is money coming out of your pocket, money you will not have to spend or leave to your heirs. Think very carefully before hiring an advisor, and if you do hire one, make absolutely sure they are a fiduciary charging reasonable, transparent fees. Let me close with some general principles for managing money in retirement. First, live below your means. Just because you can afford to spend $70,000 per year does not mean you should spend $70,000 per year. Spend $60,000. Bank the extra $10,000, reinvest it, let your portfolio grow, give yourself a cushion. The less you spend, the longer your money lasts, and the more margin of safety you have. Second, be flexible. If the market crashes and your portfolio is down, cut your spending for a few years. Skip the vacation. Drive the car another year. Eat out less. This gives your portfolio time to recover without forcing you to sell at the bottom. Retirement spending does not have to be fixed. It can be variable based on market conditions. Third, stay healthy. Your health is your most valuable asset. If you stay healthy, you need less money for medical care. You can stay in your home longer instead of needing assisted living. You can enjoy life more. Invest in your health. Exercise. Eat well. Get regular checkups. Take your medications. Do not smoke. Drink in moderation. These are the best investments you can make. Fourth, stay connected. Social isolation is terrible for your health and happiness. Stay in touch with friends and family. Join clubs or organizations. Volunteer. Do things you enjoy. Retirement is not just about managing money. It is about living a fulfilling life. The money is just the tool that enables you to do that. Fifth, have a plan for your estate. Make sure you have a will. Make sure your beneficiaries are up to date on all your accounts. Consider a living trust to avoid probate. Have power of attorney documents so someone can manage your affairs if you become incapacitated. Have healthcare directives so your wishes are known if you cannot communicate. Do not leave a mess for your heirs to sort out. Get your affairs in order. It is one of the most loving things you can do for your family. And finally, enjoy your retirement. You worked hard for decades. You saved. You sacrificed. You earned this. Do not spend your retirement paralyzed by fear about money. If you build a fortress portfolio, if you are smart and conservative with your investments, you are going to be fine. You are going to have enough money. So relax. Enjoy your grandkids. Travel. Pursue hobbies. Do the things you always wanted to do. That is what retirement is for. The money is there to support the life you want to live, so go live it.